For decades, a quiet but systematic pattern has shaped how men and women approach money. Walk into any bookstore, and you'll notice something striking. The finance section overflows with titles aimed at men: aggressive investment strategies, stock market guides, real estate empires. Meanwhile, books on budgeting, coupon clipping, and household money management cluster in a different corner, marketed almost exclusively to women. This is not coincidence. It's the result of deliberate marketing strategies, financial industry gatekeeping, and deeply embedded cultural narratives that have persisted for over a century. This is the story of how women came to be taught to budget, while men were taught to invest, and the staggering wealth gap that gap has created. If you want to understand the systemic forces shaping financial inequality, please subscribe to this channel. We explore the hidden structures behind the world you see every day. Let's start with the history. In the 1920s and 1930s, as stock markets began to emerge as legitimate wealth-building tools, a curious division emerged. Financial institutions and investment firms were almost entirely male-dominated spaces. Boardrooms were decorated with mahogany and leather, places where only men were invited to sit. The language of investment was coded as masculine, aggressive, risk-taking, powerful. Meanwhile, women were entering the workforce in greater numbers, but their financial education followed a different track entirely. Advertisers and financial marketers made a strategic choice. Rather than teach women to build wealth through investment, they taught women to manage scarcity. The message was simple and pervasive. A woman's job was to stretch every dollar, to make do with less, to be the guardian of household resources through careful spending. Budgeting became feminized. It became about denial, about sacrifice, about making sure the family had enough. Investment, by contrast, remained masculine. It was about growth, power, and building empires. This wasn't an accident. Magazine advertisements from the 1940s and 1950s revealed the deliberate construction of this narrative. Women appeared in ads managing household budgets, clipping coupons, choosing cheaper brands. They were portrayed as protectors of family finances through restraint. Men, meanwhile, were shown in completely different contexts, as investors, as decision-makers in boardrooms, as men who understood money in terms of growth and expansion. The financial industry didn't create this division from nothing. They amplified existing gender roles and then packaged them as timeless truth. By the 1960s, investment clubs were thriving across America, but with a striking demographic reality. 90% of investment club members were men. When women formed investment clubs, they were often treated as curiosities, as hobbyists, rather than serious wealth builders. Meanwhile, women's magazines devoted pages to household budgeting tips, teaching women to maximize their husbands' paychecks through clever spending. The cultural message was unmistakable: men invest, women budget. The financial services industry reinforced this division through deliberate exclusion. Brokerages maintained informal networks where investment opportunities were shared among male colleagues over drinks or golf. Women were rarely invited into these circles. When women did try to invest, they encountered dismissive attitudes from advisors who assumed they lacked the sophistication or risk tolerance for the stock market. Women were steered instead towards savings accounts and bonds, the supposedly safer, more conservative options. The industry had created a self-fulfilling prophecy. By denying women access to investment education and opportunity, they created the very situation they claimed to explain: women being more risk-averse than men. Let's examine what this actually meant for wealth accumulation. Imagine two people, a man and a woman, both earning $40,000 per year in 1980. Both are financially responsible. The difference is in what they were taught to do with their money. The man, influenced by workplace culture and media, was encouraged to invest. He opened a brokerage account. He bought stocks. He reinvested dividends. By 1990, his initial investments had grown substantially. The woman, influenced by decades of cultural messaging about female financial responsibility, focused on budgeting. She was careful with money. She saved diligently. But her savings sat mostly in low-interest accounts. Fast forward to 2020. Both are now retired. The man's disciplined investing over 40 years has created a portfolio worth roughly $2.3 million. The woman's careful budgeting and conservative saving created a nest egg of approximately $380,000. Same income, same discipline, different outcomes. The gap isn't due to personal failings. It's due to the systems they were embedded in. This pattern compounds across generations. A man who builds wealth through investment can pass that knowledge to his children. He can teach them about stock markets, about risk, about growth. His daughter might be taught this too. But statistically, women were far less likely to receive this education from their parents or communities. The cycle perpetuated itself. Mothers taught daughters to budget. Fathers taught sons to invest. The gap didn't narrow, it widened. The financial services industry maintained this system because it benefited them. When women approach investing, they do so later in life, with less capital and with less confidence. This means they accumulate fewer assets to manage, which means less fees for the industry. But more importantly, it maintains a system where men control the majority of investable assets. Men make up roughly 80% of high net worth individuals in America today, not because they're inherently better at money management, but because they were systematically taught and encouraged to invest, while women were taught to budget. The marketing has evolved, but the pattern persists. You'll see investment apps advertising to men with language about building wealth and financial freedom. The same apps market to women using different language: financial security, protecting your family, peace of mind. The subtle difference in messaging channels men toward growth and women toward stability. It's not obvious, but it's consistent. It's strategic. Like this video if you're seeing these patterns in the media you encounter. The more we acknowledge these systems, the more we can resist them. Let's look at the education pipeline. In high schools today, personal finance courses are becoming more common, but studies show these courses disproportionately emphasize budgeting and debt management for all students. Investment education remains rare. When investment is taught, it's often presented as advanced or risky, something most people shouldn't attempt. Compare this to how investment is portrayed in other contexts, not as risky gambling, but as normal wealth building for the middle class. The double message is clear. Investment is for some people, budgeting is for everyone. And historically, women have been placed in the everyone category. Corporate benefits packages reveal this divide too. When companies offer financial education workshops, the ones attended by women tend to focus on budgeting and saving. The ones attended by men more often include investment fundamentals. When companies match retirement contributions, men statistically invest their employer match more aggressively than women. Not because of different risk profiles, but because they were taught that investment is normal and expected. The wealth gap isn't abstract. It translates into concrete life outcomes. A woman without investment knowledge and experience is more likely to be financially vulnerable in retirement.